Two numbers. Same moment. Dollar index at 99.02, silver at 73.80, and on the other side of the world, Shanghai is pricing that exact same silver at 85.69. That is an 11.89 gap. That gap is not closing. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Two parallel pricing systems now exist for silver. One is pricing monetary policy. The other is pricing physical reality. They cannot both be right for much longer. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today: the US dollar index and the Federal Reserve's frozen policy stance. The DXY reclaimed 99.02 on Monday, April 13th, 2026. That move followed the collapse of Islamabad peace negotiations on April 12th. U.S. Central Command announced a naval blockade of all Iranian ports, effective 10 a.m. Eastern Time today. That blockade sent WTI crude gapping up 7 to 8% at the open to approximately $97 to $104 per barrel. Higher oil means higher inflation. Higher inflation means the Fed stays frozen. The Fed stays frozen means real yields stay elevated. Elevated real yields mean the dollar stays bid. And a bid dollar mechanically suppresses dollar-denominated non-yielding assets. Silver is down 2.5% on the session. The sequence is not random. The timing is what deserves scrutiny, not the dollar move itself. The timing. Think about what that sequence actually means. March CPI already printed at 3.3% annually, the largest monthly increase since June 2022, sourced from the U.S. Bureau of Labor Statistics. The April print will reflect a full month of oil above $97. That number is not going lower before it goes higher. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time the dollar index held above 99 with real yields above 4% simultaneously, silver underperformed for weeks before physical demand created an irreversible structural floor. The dollar is not the story. The dollar is the distraction. The real story is what Shanghai is pricing right now. Let's build it out. Now let's build the full picture, because the dollar yield vise on Western silver does not exist in a vacuum. The Shanghai Gold Exchange Ag T+D physical delivery contract closed at 85.69 per ounce on April 10, 2026, sourced directly from goldsilver.ai live Shanghai premium data. COMEX Western spot closed at 74.38. That is a 9.39 premium, or 12.31%, in favor of Shanghai. The 6-month average premium, also sourced from goldsilver.ai, is running at 6.47 per ounce. Current levels are 45% above the already elevated 6-month trend. COMEX registered silver, the only inventory immediately available for physical delivery, stands at 76 million ounces, confirmed by Blowfin research from CME Group daily metal stocks reports for late March 2026. Total silver open interest on COMEX sits at 576 million ounces equivalent. That is a coverage ratio of 13.4%. Below 15% is CME classified stress territory. 13.4% is below that level. In the past 30 days, 1.5 million ounces, 1.9% of registered inventory, have been withdrawn from COMEX vaults. The rate of drain is not slowing. It is compounding. The ones who called the physical paper divergence in silver a fringe concern, the data is not supporting that position right now. And here is what makes that picture even harder to ignore. The gold-silver ratio sits at 62.6 times, gold at 4,148, silver at 73.80. Earlier this year, that ratio was above 107 times. It has compressed dramatically, and it is still historically elevated, meaning silver remains undervalued relative to gold by any multi-decade standard. At the same time, gold's COMEX coverage ratio is structurally healthier than silver's. Gold's institutional liquidity is deeper. Gold's safe haven bid from the geopolitical crisis partially offsets dollar headwinds in a way silver's industrial profile cannot replicate in the short term. That is not a contradiction. That is the setup. Two metals under the same macro pressure, responding differently because their structural positions are different. And before anyone takes the gold-silver ratio compression as a near-term green light for silver, setups can take a long time to resolve. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Here is the number most people are not connecting to silver right now: 20%. That is the share of global daily oil trade moving through the Strait of Hormuz. As of April 13, 2026, that strait is effectively blockaded. U.S. Central Command confirmed the blockade targets all maritime traffic entering or exiting Iranian ports, sourced from Al Jazeera's direct CENTCOM statement reporting. WTI crude is at $97 to $104 per barrel. The International Energy Agency has described the Strait of Hormuz disruption as the largest oil supply shock in the history of the global oil market. March CPI at 3.3% annual is the confirmed initial impact. The April reading will capture a full month of blockade pricing. CME FedWatch data shows 0% probability of a Fed rate cut in 2026. 0. Markets are still pricing an eventual resolution. Look at WTI above $97 and a Fed at 0 cut probability, and tell me what confidence you have in that assumption. When markets start pricing the reality of sustained energy disruption, the dollar strengthens further. Real yields stay elevated. Non-yielding assets face continued mechanical pressure. Silver's Western paper price faces that vise in full force right now. That is the historical pattern. Every time an energy supply shock of this scale has combined with a frozen central bank, paper prices of non-yielding assets have underperformed physical prices for a defined window. It has not been different yet. Silver Western spot at $73.80. Session opened at $75.90. That is a confirmed Monday gap of 210, or 2.76%, at the Asian Open. Shanghai last quoted at 85.69. Premium standing at 939, short-term picture, DXY at 99.02, and the 10-year Treasury yield at 4.29 to 4.32% are the dominant mechanical suppressors of Western paper silver right now. If DXY holds above 99 and the 10-year yield stays above 4.25%, Western silver faces continued pressure towards $70 to $71 technical support, confirmed by the 200-day moving average structure on the daily chart. If the Hormuz blockade produces a credible diplomatic off-ramp within 48 to 72 hours, oil retreats, March CPI proves the peak, and silver reclaims $76 to $82 as paper markets reprice de-escalation. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what silver does tomorrow. Nobody can. If you think you know, good for you. This is a confirmed Monday gap session. Live geopolitical blockade, 0 rate cut probability, and a dollar recovering above 99. That combination does not produce clean setups. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. DXY breaking above 100 would accelerate mechanical selling pressure on dollar-denominated silver toward the $68 support level. The 10-year Treasury yield pushing toward 4.5% on hawkish Fed signals would further compress the bull case for non-yielding metals across all time frames. If the Shanghai premium narrows due to Chinese industrial demand softening, the single most important structural support for the physical paper divergence thesis weakens materially. The bull case is equally real. COMEX registered silver at 76 million ounces, covers just 13.4% of 576 million ounces of paper claims. A coverage ratio in CME documented stress territory, with 1.5 million ounces drained in the past 30 days alone. The Shanghai Gold Exchange Ag T+D contract pricing silver at 85.69, a 12.31% premium over COMEX, reflects real physical scarcity that dollar index levels cannot explain or eliminate. The Silver Institute projects a 67 million ounce annual supply deficit for 2026, the sixth consecutive annual deficit, with China's silver imports at their highest level in 8 years. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. 2 markets, 1 metal, prices 11.89 apart. The dollar and yields are writing one story in the short term. Shanghai's physical delivery market is writing a completely different story over the medium term. Both cannot be correct simultaneously over a 3 to 6 month horizon. The ones running the OG John AG 1.0 playbook do not wait for that resolution to become obvious before they have already thought it through. Don't take my word for it. Verify every number I gave you today. Check the data yourself. U.S. Bureau of Labor Statistics at BLS.gov for the March CPI 3.3% print. CME Group official daily metal stocks report at cmegroup.com for the 76 million ounce registered silver figure. Goldsilver.ai for the live Shanghai premium data and the 6-month average. The ones who verify do not argue about it. Logic over hype. Always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0, out.